Well, a service provider being an asset-light business today has much more limited options than it had in a more robust economy or the pre-2008 economy. So the useful capital providers for asset-light businesses will be those that understand service models, recurring revenue models, people-intensive models, and somewhat lower margin models than you get, lower gross profit margin models than you get in a product business. So the useful capital providers will have to be people that understand that. That demeanor of service businesses. But more importantly, the useful capital buyers are going to be looking for recurring revenue streams, good productization, pricing functional to the client and the client's buying behavior, as well as a business process or service delivery process that allows scalability of the cost. In other words, an increase in revenue should equal an increase in percent of gross profit. Well, the capital providers should basically have four key assets that they bring to the business. One of them is a keen understanding of the service business and the attributes of a service business versus those of a product business. Second, they must understand the people perform aspect of a service business. Service businesses are a function of people, process, and technology. So they need to understand that balanced approach as it relates to the business model. Third is they need to understand that the ingredients of scalability. What is scalability in a service company? It's much different in a product company than it is a service company. And then lastly is they must understand that the balance sheets of service companies not being asset light, therefore need to understand the liquidity aspects. And okay, there's two sets of venues. One of them is a board that has an financial institution backing the company. The biggest mistake there is that the board is stacked, or most of the seats are occupied by financial people or people from the institutional investment world. So the first mistake there is not too many financial people in the seats. Second is have a balanced board that has operations representation, marketing representation, strategic representation, and financial representation. Same thing applies on a private company that doesn't have institutional investment, whether it be an advisory board or a formal board of directors. You need to have a board that has professionals in the different functioning areas of a business and can add value and input to that business in all the functional areas. In a service business, other than a good market and good products and a good value proposition, management science is the key to eliminating execution risks and maximizing economic performance of the company. So therefore, the more you have processes, the more you have measurement and metrics, the more you measure. Okay, what you measure is what you'll get. Okay, so you want to measure the right things, and then you want to react to what those measurements tell you. Common mistake that a lot of service company operating management make is that the data and the metrics are right in front of them. They don't respond to them appropriately. So make an appropriate management action as a result of what the measurement of metrics and the management science tells you. Well, I can tell you the most common mistake they make is they try to do what's conciliatory or politically astute within their organization, particularly with people that they've worked with for a long period of time. Generally, the case is that behavior is not good for the business. A leader needs to evaluate a situation, determine what needs to take place, give that directive, and ensure that the directive is carried out and that the business progresses to where it needs to, irrespective of the politicalisms and irrespective of how people may feel at that point in time. Success breeds happiness. Lack of success breeds empathy. Well, in a service business, particularly in a slow growth economy, the chief strategy officer role, whether it be done by an outsider or an internal person needs to be an identified role, because today that's one of the more important roles. As the marketplace changes, as demographics change, as psychographics change of the buyer, and the financial structures around the buyer change, the chief strategy officer needs to be clearly attuned to what those changes are and pull the company towards the marketplace and the client changes.
Basis for the company.
Well, on a day-to-day basis, the chief strategy officer should be looking at the sales data, looking at the pipeline, interviewing the salespeople, and determining what they're hearing in the marketplace as an information source only, not to create action. Second is they should be listening to the channel partners and the other people who are distributing, or the other venues that are distributing the company's products and services, and get their feedback. The third thing should be doing on a daily basis is monitoring the competition and monitoring what the competition is doing, what changes they're making to their value proposition. And then lastly, they should be looking into the marketplace and identifying and predicting customer buying behavior or market trends that are going to affect the company and its products and services. And each one of those needs to be done daily. Chief strategy officer work's not an event. It's not something you do for 3 hours a month. It's an ongoing process, just like your sales process is, just like your management process is, like your financial reporting process. Chief strategy officer for a service business should be one of the number one things on a CEO's mind.